Good morning. It's Jeffrey Christian of CPM Group. It's just after 11 a.m. here in New York on Tuesday, August 1st. I have several topics I want to cover today. Gold and silver, the current market situation, the strength yesterday, the weakness today. I want to go over some issues with the dollar. I mentioned some last Friday's video, and I want to clarify one thing that I misspoke about. As well as talk about the state of the dollar. And I want to talk about what I've termed here as the fear business. That caravan of fearmongers that go around the United States and Canada and probably the rest of the world trying to scare people about a dystopian future or a dystopian present and getting them to buy gold and silver for all the wrong reasons. So here are gold and silver prices. And again, gold is at record levels. We are now into the third quarter. The second quarter saw record level gold prices. Silver prices have lagged gold to some extent in that they have not reached record levels the way gold has in 2020, 2021, 2022. They've been very strong. If you understand the fundamentals of the silver market, for example, if you've read CPM Group's 2023 Silver Yearbook, which is available on our website, you would understand why silver is lagging gold. There are a lot of people who will tell you, oh, silver always plays catch-up. That's not necessarily true, and it's not necessarily a good reason to expect it this time, even if it were true historically. Things have changed. But, gold and silver prices rose very strongly at March, April, May. They've come down in June and July, and then they came back up in the second half of July. We actually, I'll come back to the markets a little bit after I talk about the state of the economy. I used this chart in Friday's video, and I want to repeat it here because we need to talk about the economy. Today we had a U.S. jobs report come out. We've seen strength in the European economy. We're seeing strength in the United States economy and some other economies. The jobs report showed a lot of economic strength. There were some signs that the employment situation is shifting, a reduction in the jobs available, but there's still a very large number of jobs available, and you have very low unemployment in the U.S. in terms of U.S. workers. There are problems there. But that jobs report then put a sort of spooked the market. And whereas the markets had risen yesterday on the idea that the stronger economy, we would avoid a recession and things would be better, today you saw concerns that the stronger economy will lead to higher interest rates than the market consensus has it, which is probably true. And you saw a sell-off from yesterday's highs. So it's interest rates. The market consensus has gone from imminent recession in 2022 already and all through the first half of 2023. Now all of a sudden it's, there's going to be a soft landing and, quote, no recession. There will be a recession. The question is when. It probably won't be this year because the economy is doing better than the market consensus would have had us believe over the last 18 months. But there will be a recession. CPM Group has had this, there are all these problems there hanging over the market that can contribute to the onset of a periodic economic contraction. CPM Group has been writing and talking about the probability in our projections of a recession not emerging until 2024, 2025, which is almost upon us now. And we've been projecting a relatively large, damaging recession in the industrialized world, which also drags down economic activity in the developing and emerging economies. We are presently sort of saying, well, have we been projecting too severe of a recession? And in our Precious Metals Advisory, which will come out later this week, and that bubble chart will be updated in the Precious Metals Advisory. In the Precious Metals Advisory for August, we talk about the various scenarios for recessions or no recessions and probabilities, and the possibility of a shorter, shallower, less destructive recession in 2024 or 2025, similar to the ones that you saw in 1991 and in 2001, which you can see hardly show up on this chart of global and regional real GDP. These are annual projections, and if you go back to 1991 or 2001, you'll see 2 or maybe 3 quarters of contraction in real economic activity, i.e. a classic defined recession. But it didn't show up in terms of annual contraction on a 4-quarter average basis. Our expectation is still that you probably could, given all of these and other things that aren't on this list, our view is still that we could have a pretty severe recession next year or 2025. But the possibility of a more shallow recession has probably increased in our scale. We're working through that now, and we'll keep you posted on our thinking. So what's all this mean for precious metals? Monday, CPM Group said, look, gold is testing $2,000. Silver was testing recent high for it. And we thought that the prices had the scope to rise a little bit further over the next week or two. We still believe that, and we wouldn't be surprised to see gold back over $2,000. It's fallen down below it. It's off about $21 from yesterday's close as I speak. Silver's off about 50 cents from yesterday's close. We wouldn't be surprised to see them come back up and test Monday's highs, maybe move above Monday's highs, maybe move back toward where they were in early June, late May, early June. We still expect or see the scope for prices to weaken later in August and over the course of August into September. And then we still expect prices to rise further. And again, gold is at record levels. So anybody who starts telling you that they don't understand why gold prices are so low, you can ignore them. I want to talk about the dollar now. And I made the comment in Friday's video and at the Wool Investment Media Conference. I said that somebody had said, well, the dollar has been falling in terms of its purchasing power since 1913. And I made the comment that there are 3 types of people who would say that. People who are demagogues, who think that the Fed is the root of all evil. I won't say anything more. People who just don't know the history of gold, the dollar's purchasing power. And demagogues who don't know the history of purchasing power. And I made the comment that currencies depreciate over time because of inflation. Their purchasing power depreciates over time because of inflation and because of just the arithmetic of earning interest. If you have 100% of something and then you charge interest and you make another 2% or 5%, you have reduced the value of the original 100%. And I said that the dollar has been depreciating since 1792, the creation of the dollar. That's actually wrong. You can see here the orange line is the purchasing power of the U.S. dollar. And this is from Roy Jastrom's landmark Golden Constant, where he pulled together all of these numbers. And we've built off of it since he produced that book in the, I guess, early 1980s. But you can see that the dollar actually was very volatile in the 19th century. It fell sharply during the Civil War. And then it rose after the Civil War up until 1898, which was the year of the Spanish-American War. And the dollar has been losing purchasing power since 1898. You can see several spikes down the Civil War, the Spanish-American War, World War I, World War II. Wars are destructive of the dollar's purchasing power because when you're in a war, you borrow money and you spend money as much as you need to win. And if you lose, well, your currency goes to naught. And if you win, you've taken on a lot of debt that you have to pay back. Henry V knew that after the Battle of Agincourt because he had borrowed a lot of money and gold from various people in England in order to finance his invasion of France, which ended with the victory at Agincourt. The dollar has fallen since 1898, not since 1972, but it has fallen. And you can see here that the dollar fell very sharply from 1898 into 1913, the creation of the Fed. The Fed was actually legally organized in December of 1913, and then it was put together in 1914, and it probably started actually being a national bank either in late 1914 or early 1915, by which time we were into World War I. And so the Fed was probably created around here. Yeah. And we saw World War I depreciate the dollar. It's not the Fed that's caused the dollar to lose purchasing power. It's inflation and the ravages of time. And it's not just the dollar. The orange line here is British pound sterling, and this goes back to 1700. Again, based off of Roy Jastrom's data that he pulled together, updated since the 1980s by CPM Group. The real value of currencies, including gold and silver, deteriorates over time because of the effects of inflation and interest rates. The blue line on both of these charts is the purchasing power of gold. So when somebody tells you that gold's purchasing power stays constant, say, yeah, I don't think that's actually the case, because if you look at it, gold's purchasing power here since 1800 has fallen very sharply. Then it rose very sharply in 1980, briefly, came back off, rose again. Not very constant. And in fact, Roy Jastrom's book was misnamed by the publishers. And the thesis of the book is the golden constant is a myth. Gold's constant purchasing power doesn't actually exist. And Roy, in his summary, said, I just don't understand where this myth came from, given the quantitative evidence. But as we know from listening to the fearmongers, quantitative evidence doesn't necessarily factor into a lot of people's cognizance. So the dollar's fallen, the pound's fallen, gold's risen back, but it's far from where it was, like, say, prior to 1913. These then, I showed you last week, this is the dollar. It's not collapsing. It has come off sharply since November, and it is about 30% higher than it was in the period 2007, 2009 to 2015. And it's about 10% higher than it was in 2021. Dollar's not collapsing. I have a couple other charts from St. Louis Fed. This is going back to 2009, and you can see the sharp increase since 2021. And then you can take it back actually to 2006, and you can see that long period of sideways movement after the Great Recession, and then how the dollar started rising around 2014. Now, one of the things that the fearmongers keep talking about, and I saw a video this morning about central bank digital currency, and they want people to think that central bank digital currency is something bad and evil, and it's going to lead to the government being able to monitor everything you're buying and decide when to turn off your money and not allow you access to money. And I pointed out, all of those powers already exist. Central bank digital currency is just the latest or future evolution of currency, how you move the money around. In the 12th and 13th century, if you lived in Belgium and you wanted to buy spices that the Venetians had brought in from the Far East, you had to take gold and silver and have a carriage take it from Belgium to Venice. which is why we had a lot of highway robbery back then. Jacob Bucker, who created a lot of modern finance in the 13th century, 14th century, said, wait a second, I have a bank in Belgium, I have a bank in Venice. Why don't I do this? They both belong to the same company. And if somebody in Belgium wants to buy spices in Venice and pay us for gold, pay for the spices in gold, we can make a ledger adjustment and say, okay, that gold that fellow has in Belgium is now ours, and some of the gold we have in Venice is his, and he can use the gold in Venice. And he really did a lot of damage to the whole industry of highway robbery. But it was paper gold. Oh my God, oh my God. That's the 13th century. There has been a constant evolution of cash, how we exchange money since that time. In the 19th century, we went from gold and silver coins to paper that was supposedly backed by gold and silver coins, but often wasn't, because the bankers didn't keep the gold and silver coins. They just issued the paper because state auditors didn't come around and say, hey, do you have that gold and silver in the vault the way you say to people who buy your currencies? Which is one of the reasons why you had constant bank runs in the 19th century into 1913, and why you had big periods of hyperinflation and big periods of depression in the 1870s, 1890s, 1880s, and why you had recessions from 1907 until 1913. 60 of the 90 months saw recessions in the United States, thanks to the instability of the pre-Fed banking industry. You know, I told an anecdote the other day about talking with my good friend Alan Greenspan about the gold standard in the 19th century. And I said, you know, how can you be that pro-gold standard when you've seen these periods of hyperinflation and depression in the 1870s through 1890s? And he said, well, of course you had that because we were on species. We were using gold and silver. And when there was a lot of gold, there was hyperinflation. And when there was a shortage of gold and silver, you had depressions. I also showed that same GDP chart in the 1980s in a meeting in Washington. And there was a fellow named Ron Paul who was there, and he kept talking about how the Fed was the root of all evil, and the purchasing power had fallen, and the economy was much more volatile post-Fed creation than it had been prior to it, which is not the case in terms of GDP, in terms of inflation, in terms of people starving to death. The U.S. economy is much less volatile than it was prior to 1913. And when I showed that, John, I said, I just don't understand the dichotomy, or the, you know, how can you say that when confronted with these numbers? And he got up and walked out, and he's avoided me ever since. I take that as a compliment. So central bank currencies are nothing to be afraid of. And anybody who's trying to make you afraid of them, you can honestly ignore. And that takes me to the fearmongers. Now, I went to Florida last week. Rick Rule and his staff invited me to come down to their natural resource conference and speak at the end. I was the last speaker before they wrapped up the conference. And I asked me to speak about the world is not collapsing, but gold and silver are still good investments. And it's interesting. I mean, Rick is doing a great job, and Rule Investment Media are doing a great job repositioning themselves to be the providers of unbiased, accurate, honest information about mining and about metals. But at this conference, they still had this caravan of purveyors of fear-mongering that follows, there's a carnival circuit. It's the Money Show, it's New Orleans, it's Vancouver Resource Investment Council. And you have this caravan of people who have been consistently wrong, consistently talking about $10,000 gold imminently. Oh, wait, now it's $20,000 gold. And $1,000 silver or $100 silver. Just consistently wrong, constantly trying to scare people into buying gold and silver because the world's going to collapse, the treasury's going to collapse, the dollar's going to collapse, your bank's going to collapse. And we have spasms of economic problems, and then we dust ourselves off and we move forward. It's a capitalist system. But you have this circuit of carnivals, and you have this caravan that goes from place to place to place. And conference organizers have to invite them because they attract people to pay a ticket to come. Hopefully that's changing. But one of the things I realized, there were a lot of people who said, good God, Jeff, love your videos, love CPM Group's reports. So glad you're here, a voice of reason in the midst of all these people waving their arms and coming up with all kinds of weird things that they're trying to scare us about, that they've been talking about for their entire careers, whether it's 2 years or 20 years or 40 years. I mean, I know one guy who's been talking about the collapse of the U.S. economy since the late 1960s, and he still is. So he'll probably be right, but he's probably going to be dead by then, right? But what hit me was, and I've seen other signs of this, the fearmongers are losing followers. There are people who are saying, I just can't. We had one company that came to us and said, Jeff, we want you to talk to some of our clients because they're sending us these notes saying, listen, I've been listening to you for 40 years and I've just lost so much money. And I've missed out on the two biggest equity market upward moves in history and the two biggest bond rallies in history. I just can't afford to continue to listen to you. So I think the fearmongers are losing followers. But another thing that hit me is, you have this circuit of carnivals that this caravan goes to. You don't have a similar circuit of realistic, informed, honest mining and metals conferences. We'll find companies that put together overall market seminars and conferences, but if you put mining and metals into one of those, they get swallowed up because they're so small and inconsequential to the broader economy and the broader investment market. You don't have metals and mining conferences that really say, we're going to bring you realistic, informed people. So there's scope for change there, and hopefully we'll see it soon. That's all I have for now. I've gone on a long time. I apologize for that, but I hope you find this information interesting and insightful and thought-provoking. And we'll talk to you later in the week.